Hello everyone, this is Trader Shivai. So this is the fourth video of our ongoing series in English. Okay, so today we are going to learn about the auction market theory. Okay, friends, auction market theory, according to me, is the most important thing. People are giving lots of preference to order flow, but I give it more preference because with help of auction market theory, you are able to get the context. Okay, so I will show you on the charts as well. Okay, so let's start with the auction market theory rules. Before that, let's try to understand few basic concepts which will help us to understand auction market theory even better. Okay. So guys, this is quite common that you see market consolidating for a lot of time and then suddenly you see a breakout that everybody knows. Okay. Here we call them as balance and imbalance in profile. Okay. So when the market is consolidating, we call it as a balance. Okay. And when market is trending, we call it as imbalance. All right. Now, balance forms due to responsive price action and imbalance forms due to initiative price action. Okay. So friends, as a market profile order flow trader, we give lots of importance to the value of instrument. Okay. We are not looking only price as opposed to price action concepts. Okay. So in price action, everything is dependent on the price. But here we are looking at the value. Is the value of an instrument is above its real value or below its real value? Okay, that is very important, or it is at its exact value. So based on these conditions, our hypothesis, our trading style changes. Okay, so let's understand what is responsive price action and what is initiative price action. Now, let's first try to understand how balance forms, and then we will try to understand how imbalance forms. Okay. Now, friends, balance forms generally when the price of an instrument is, inside its value area, or you can say in the range of its real value. Okay. So for example, if everybody thinks that the price of this car can be between 15 lakh and 15.5 lakh, and if you're getting that, car in that price range, then you will be happy. Okay. So for example, let's take the example of an old car. Okay. So suppose you are going to buy a second hand car and you're not sure what is its exact price. So what you're going to do, you're going to ask lots of your friends whether it's a good price or a bad price. Okay, we all consult that if it's a good price or it's a bad price. So if everyone confirms that, okay, no, this is a good price, you can buy this car at 15 lakh or 15.5 lakh or in this range, you are happily going and buying this. Okay. So you see, when trading is happening, right? So when we form a value area, most of the trading is happening at that particular level or that particular range. Okay. So that is why we call it value area, because most of people think that this is the real value of that instrument. Okay, so that is how we get the value area. So now what happens? Someone is selling the same car as 15.5 lakh, and now it is actually a little costlier. Okay, so what happens if some customer is ready to buy at 15.5 lakh? Okay, so many sellers will be interested to sell it. Why? Because they are getting a higher price. The real price of that car is between 15 to 15.5 lakh, but 15.5 lakh is the upper limit. Okay. So if someone is ready to buy, suppose someone is in urgent need of car. So what he is going to do, he is definitely going to buy at 15.5 lakh. And if some buyer comes at this particular price, these sellers will be very happy to sell him at 15.5 lakh. Okay. Now, at the same time, if some seller is, in urgent need of cash and he just want to sell his car at 15 lakh, so there will be many buyers coming, okay, and they will be very happy to buy at 15 lakh because that is cheap for them, okay. So now if you see the profile, the market profile, and you see generally it's a D-shaped profile. So what does that indicate? Below this level and above this level, there is a very small trading. There's a very little trading, but here you will see lots of trading. So why there is small trading? Because when price comes below this level, lots of responsive buyers come and they just want to buy over there. So there is a lot of buying competition and price quickly moves upside. Okay, because if there are so many buyers, the price is going to go up. At the same time, if the price goes above this level, what happens now? This price is actually costly, and then there are many sellers who find this price as attractive and they are going to sell it heavily. So now what happens? There are responsive seller and the price will quickly get back into this value area. Okay, so this will explain you in a better way about our auction market theory rule number 1, about which we will talk in few minutes. So this is how the balance forms. Okay, so let me just repeat it. Why balance is forming? Because if the price is going above, the sellers are coming, they are selling, and if the price is going below, the buyers are coming and they are buying. So that is why this balance area is forming. That is why the market is in a range. Okay. So I hope we understood the concept of responsive sellers and responsive buyers. Now let's try to understand how imbalance forms. Now, friends, imbalance forms due to new information in the market, right? So you have seen that, event trading, sometimes budget comes, or if you have seen the election day, okay? So how the market has moved? Why? Because the information was new. Nobody knew which government is going to form, how the economic prospects of country are going to be, right? So if the new information comes, market reacts accordingly. So now let's understand with the help of the car example. Okay. Now suppose the same car which we talked about, it was, in the range of 15 to 15.5 lakh. Okay. Now what happens? Suppose there is a new information coming in the market, okay, that this particular brand has introduced such a technology that its safety rating has gone very, very high. Okay, so what will happen? Safety is the first priority, guys. Okay, now what will happen? People will be attracted with this car. Okay, they would like to buy this car. So now what happens? Now people would like to buy this car even at a higher price. Why? Because they think that this is the only car in the market which has best safety features. Other cars are not that safe. That is why they are ready to buy this car even at a higher price. So what is happening? New information is coming and the price has gone higher. So the price has gone above this value area, a quick retest, and the price is moving upside. Okay, so this is how a positive new information has impacted the price. So what has happened? The price has actually moved from its original value area. The price has gone up and maybe now it will consolidate over here and it will make a new value of that particular car over here. Okay, so now the new value of the car may be in the range of 22 to 25 lakh. All right. So now how does the price moves up? Because of the initiative buyers. That is also we call market buyers. Okay. So here we have responsive sellers means limit sellers. So these limit sellers were selling earlier. Now what happens when the new information comes? These initiative or market buyers, they just simply go buy, and they are simply consuming all the limit orders of these responsive sellers. When their limit orders are exhausted, the price goes up because now many people are thinking that no, the price of the car is not here. The real price of the car is not here, but above, right? So now the new value will be forming somewhere over here. Now let's talk about this example. In the same way, suppose again the new information came and now this time the information is just opposite. Okay. So the price of the car was in the range of 15 to 15.5 lakh, but the new information comes and in that information we came to know that the steering system of the car is failing badly. So there is a news that 10 to 15 cars steering system has failed suddenly. Now what will happen? Everybody who is having that car, they would like to sell the car. And do you think that the new customers are going to buy that car? No. So now everybody wants to sell that particular car. Okay. So what will happen? The price of the car is going down. The new sellers are coming. Why new sellers are coming? Because whoever is having that particular car, they just want to sell it because they do not trust the steering system of that car, right? So now new sellers are coming. They will take the price down, below this value area. Now here somewhere the price may consolidate and now the new value is formed, right? So this is how imbalance and balance, we understand, and we try to capture this movement. We try to capture the imbalance movement because here the price is very choppy, that we will talk in some time, right? So we try to capture these things. So what we are going to do, we are going to use this theory, auction market theory rules, and use of order flow to get good trades. Okay. So what are auction market theory rules? Okay. So first, let's understand. We find out balance area in chart. Okay. So what is our job? Our job as a trader is to find the balance area in the chart. Right. Now, what happens? We get daily market profile value areas, right? So we should not stop over there. We should try to look into chart and see how many days are there where the value area is overlapping more than 50%. Okay, so now let's go to chart and try to understand what I'm saying. So now this is our market. Okay, so it's a 26 June market. Now, guys, if you see what I have just said, you see these profiles. This was a profile, this was a profile, this was a profile, this and this. Can you see that their value areas are overlapping almost fully? I have just said that even if they are overlapping 50%, you should try to merge them. You should try to combine them. Now you see the 5 days profile. They are overlapping so beautifully. What you are going to do, you can either right click, okay, and merge profile to left. You can keep on doing this, okay, or you can go to these tools, drawing tools, go to shapes and text, and here you have fixed range market profile. Okay, click on that and select from here to here. So this is your range. So either you do that or you simply merge to left. Now let me mark the value area for you. So this is our value area high and this is our value area low. So these are our markings. Now I am switching off the market profile and I'm also deleting this one. Okay, now guys, look at this. This was our balance area. What has happened? The market has opened above this, came down a little bit, gave a small pullback, and then you see the move. Okay, so this is a very beautiful up move, and this is called imbalance move. So this was a balancing area, and this is imbalancing area. Okay, so now let's try to look at our auction market theory rules and see whether we could have, caught this move or not. So what was the first rule? That we try to find out the balance area in the chart. Now, what is second rule? Price accepting inside a balance area will try to travel the opposite side. Also, the price movement will be choppier inside the balance area. Okay, so now let's go to chart. So basically, if you're trading inside a value area, the price movement will be very choppier, and it will try to travel the opposite side. So if the price is at value area high, it will try to go value area low, and if the price is at value area low, it will try to go value area high. So let me switch on the market profile again. So let's talk about these days. So here we see this one and these two profiles were matching. So if we just simply merge these two profiles, okay, now again you see this is our level coming. So this was our level and this was the level. Okay, so now you see how the market is behaving next day. So on 20th June, this was the opening next day. Market tries to go down, below this level, but it fails. And where it goes? It goes to value area high. Then it again comes down and goes to value area low. Then it again goes up to value area high and then comes down to value area low. So now you see, guys, the movement is very, very choppy. And if you see this move, this is very fast move, but here the movement is very, very choppy. So when the market is inside value area, it will try to travel between value area high and value area low. Now you should try to understand that consider these as areas, not as line. You also need to, take care of delta, order flow, what is happening, absorption is happening, exhaustion is happening, all those things I have told you in the previous lectures. Okay, that is how you get a confirmation whether this is going to go down or it is going to revert back. So now let's try to understand the next rule. So how the market is going to behave inside a value area? Suppose it has entered into value area, it will give a small pullback and then it will go to value area low. It can try to go up, give a small pullback to the value area high and to the value area low. So this is how the market is behaving inside a value area. Now, price accepting outside of balance area will try to travel in the imbalance direction. Also, the price movement will be very fast in the imbalance zone. Okay, so that we have just seen in the chart. You see here, it is going price going above the value area, a small retest, and then very fast move. Similarly, if the price is going below value area, small pullback, and then fast down move. Third rule is the area of shift in conditions are often retested. See, friends, there is nothing permanent. There is nothing 100% stock market. Okay, you always have to take risk. You always have to, have money management and risk management. Now, the thing is that most of the time you will see that there is a retest to these value areas when the market is shifting condition. So this is the imbalance condition. This is the balance condition. When the market is shifting from imbalance to balance, there is a shift, okay, in condition, and then you get a small pullback to that level, to value area high or value area low. So imbalance to balance, pullback, value area high to value area low, again shift in condition, pull back, and then again downside, right? So this is how the rule number 3 is explained. Now, price often reverts back to previous balance areas, right? So when you see there's an up move or down move, when the price is reverting back, you will see the same kind of behavior in the previous balance area. So for example, this was our balance area and the price has traveled above this value area, gone here. Now here it has again made a balance. Now when it is coming down, this particular value area, it will enter again small pullback, value area high to value area low. It may, continue to consolidate here. It may again go up or go down. So if it is going down, then what was our previous value area? We are again going to take the same rules for this value area. Okay. Now, next rule is sometimes POC of the value area can give strong rejection. So what happens, friends, if this is your value area, you guys know that this is the POC where the maximum level of trading has happened. So sometimes this POC can give a small rejection. Okay. So when you are taking a trade from this value area high to value area low, so make sure that when the market is trying to go down, you be very cautious at the point of control level. So if you are getting a rejection, you quickly, get out of the trade or book at least some profit. Okay. And then other profit, let it run. So if it is going to value area low, let it go. But if it is reverting, at least you have booked some profit and then you are, exiting at cost to cost basis. So now what are some golden rules? So first is try to take trade where conditions are shifting. Why? When the conditions are shifting, say for example, this was imbalance, it is coming and to the balance. So now here, this is the best time to take trade because nobody knows where the market is going to go. But with the help of auction market theory, with the help of order flow concept, you have some idea that the market may go here. So now if you enter at this particular point, you are going to eat this entire move. Now, other people, they are going to enter somewhere at here, here, here. But what happens if the point of control is giving rejection? So their stop loss is going to hit. But for you, you are very safe. You know that this is my context. The market has come from imbalance to balance. It has given a small pullback. And if it is going down, I'm going to enter over here. Okay, so you have some cushion, right? Then try to use order flow concept at areas where condition shift is happening. How? So suppose the condition shift is happening, market is going here. Okay, market has entered from imbalance to balance. So now what you are going to see? You will see absorption of buyers. Why? Because now your hypothesis, see, you may be wrong. What may happen is the market may come down a little bit because it's an area, right? It may come down a little bit and then it can go up. Okay, so it means that it is not accepting this value. Okay, the market, although it has come down, it is not accepting this value. It is going again to the previous value. Now, So what you're going to see is, if you see the market has come down, now you see the absorption of buyers. Now you see the exhaustion of buyers, and you see the aggression in the sell side. Then you are very sure that, okay, this may travel from value area high to value area low. Again, there could be rejection from POC, but at least now your order flow is giving you a confirmation, right? So now your bigger context is that market is going from imbalance to balance. It will give a pullback, and then it will travel from value area high to value area low. Now the same thing is being confirmed by order flow. What you're going to do, you are going to take a trade. Okay, so you are going to take a trade with the stop loss somewhere over here. Friends, anytime you may go wrong. So don't make a mentality that you are going to get 100% accurate trade. No, this is never going to happen. You always have to take the risk management in the picture. Okay, so this is how you are going to take trade with the help of order flow and the auction market theory. Okay, so I hope you understood these concepts properly. In the next lecture, we will talk about VWAP and how we can apply the auction market theory in the VWAPs. And then how we can combine all these things like the market profile, VWAP, the same auction market theory rules, and the order flow. Okay, thank you guys.